Alright, this is the question in regards to one-time only special order. One-time only special order is a situation where it involves accepting or rejecting special order when there is an idle production capacity and the special orders basically have no long-runs implications to the company. This is the example. I use the example of Bis Blanket. Bis Blanket manufactures high-quality blanket at its highly automated plant in Durham, UK. The plant has a production capacity of 45,000 blankets each month. So this is the capacity of the blankets that the firms can produce. Current production is 30,000 blankets, so it is much lower than the capacity. Retail department stores account for all existing sales. Table 1 shows the expected result for the coming months, that is August. These amounts are prediction based on past data. We assume that in short run, all costs can be classified as either fixed or variable for a single cost driver, that is unit of output. Amanda Hotel is a luxury hotel chain that purchases blanket from Owl Blanket Corporation. So now we are talking about another company, that is Amanda Hotel, where Amanda Hotel is actually a luxury hotel that purchases blankets from another company, that is Owl Blanket Corporation. The workers at Owl Blankets are on strike, so Amanda Hotel must find new supplier. In August, Amanda Hotel contacts B Blanket and offers to buy 5,000 blankets from them at the price of $11 per blanket. Based on the following facts, should Bis Blanket managers accept Amanda's hotel offer? So this is a case of one-time only special order from Amanda Hotel to Bis Blanket, because Amanda Hotel want to purchase just one time only which equal to 5,000 blanket with a price of $11 per blanket. So in this information, in this question, the management have to analyze and have to think whether they should take the one-time only special order by Amanda Hotel or not. Okay. Alright, here are among the information where management accountant have to consider before they make a decision. So another things that management accountant have to consider, which includes they have to understand that no subsequent sales to Amanda Hotel are anticipated, means that this is just one-off purchase from Amanda Hotel. Another information that we need to know whether the fixed costs are affected by this one time of sales. Okay, fixed manufacturing costs are based on 45,000 blanket production capacity. So this is information that we know that the capacity is actually 45,000, and if for example they increase the production for another 5,000, it will not affect the fixed manufacturing cost because it is actually, the capacity is actually for 45,000. So currently they are actually producing 30,000. So if they add another 5,000, it's still within the capacity of 45,000. Other than that, no marketing cost will be necessary for the 5,000 unit of one-time only special order, because it is something that specially direct, that we don't need to do any marketing. It is Amanda Hotel that come to the Bis Blanket company and want to buy blanket from Bis Blanket Corporation. Other information that management accountant have to consider, which includes that accepting this special order is not expected to affect the selling price or the quantity of the blanket sold to regular customers. So the customers that they already have at this point of time, where they produce 30,000 blanket, so if they add another capacity of 5,000, it will not affect the current production, the current quality will not affect the selling price to the regular customer, which means that there's no specific other cost that need to be borne by other customers. So just by adding this volume, that is another 5,000, it will not affect the current production and delivery and the quality to our current customers. So that is among the information that the management accountant have to consider, and this is also a part of the analysis shown that all of this information are being taken into account by the management accountant. Alright, so these are like the information given to you. Alright, so the budgeted income statement for August for Biz Blanket. So these are among the information given to for these questions. The unit sold is 30,000, and here are the information about per unit cost and the revenues, because per unit is currently sell for $20, so the revenues obviously is 600,000. And at the same time, they have variable manufacturing costs, alright, and total costs, fixed manufacturing costs, total cost of goods sold, and at the same time, they also provide with the information regarding marketing costs. Okay, so marketing costs, it includes variable marketing costs as well as fixed marketing costs. Okay, so the cost of the products is basically 570,000. Alright, so this is something, like we add this 360 plus with this total marketing cost plus total cost of goods sold, and then you can get here 570,000. This is the revenue. So revenue minus with full cost of the products. So we can get here the operating income of 30,000. Okay, when the company produce 30,000 unit of blanket. Okay, and other information given to you, which includes like this special notes A, B, and C. A, which means Biz Blanket occurs no R&D, product design, distribution, or customer service cost, means that there's no other additional cost here. In regards to B, it is refers to variable manufacturing costs. Variable manufacturing cost per unit, they specify that it means it's a direct material cost per unit, alright, plus variable direct manufacturing labor cost per unit, plus variable manufacturing overhead cost per unit. So that's why they come up with this calculation. Okay, $7.50. Another information given, which includes fixed manufacturing cost of 4.50. Alright, so this fixed manufacturing cost, actually here are the information given to you. The fixed manufacturing cost per unit comprised of fixed direct manufacturing labor cost per unit plus fixed manufacturing overhead cost per unit, and the total is $4.50. Alright, here is the analysis or the calculation where we are going to identify whether that kind of information is relevant or irrelevant before we make a decision whether we want to accept the special order or not. So based on this analysis, you can see these three columns. One is without special order, that is 30,000 unit. The second column with the special order, and the third column is the difference between column 1 and column 2. This is the difference if we produce 30,000 units or 35,000 units. As for the revenue, we know that if in the production of 30,000 units of the blanket, per unit is 20, and number of unit is 30,000, so times with 20, so we can get here 600,000. With the special order of 35,000, we already know that the information given to us that this 5,000 times with the $11 the price offered by Amanda Hotel. So that's why it now increases to 655,000. Okay, and the difference is obviously between 600,000 with 655,000. We can get here the difference of 55,000. This is in regards to revenue. When it comes to manufacturing, okay, the manufacturing cost is similar regardless whether they produce 35,000 or 30,000. So basically 262,500 times with 7.5, I mean that 7.5 times with 35,000, so we can get this 7.5 times with 30,000, they can get this information. So the variable manufacturing cost is 37,500. all right, now we look at other costs. Okay, so basically the variable manufacturing cost is a relevant information because it differs between 30,000 units and 35,000 units. So this is relevant information, relevant costs that we need to consider. However, there are certain other costs that are not going to change regardless whether they produce 35,000 or 30,000. So that kind of information is considered as irrelevant. So as if that in this situation, okay, the marketing cost is 150,000. So if, for example, they produce 35,000 units, still the amount is 150,000 for marketing. So that's why you will have a zero. There's no difference whether the firms accept or didn't accept the special order. So this is irrelevant information. Other information that we should know that the fixed cost in regards to manufacturing, marketing, all of this also become irrelevant because as we know, once we increase the production, it will not affect our capacity. So that's why we don't need to, that the manufacturing and marketing costs will remain the same. Okay, although the firms increase the production another 5,000. All right, so if we calculate here the sales, the revenue minus with the manufacturing cost, then we can get here the contribution margin of 17,500, and this is our operating income basically because there's no other fixed cost that firms have to cover. Okay, so this is among the calculation given to you, 5,000 unit times with $11. Okay, this is how we calculate our revenue. This is how we calculate our variable costs. All right, and no variable marketing cost will be incurred for 5,000 unit because basically we don't need to do any marketing activity here because it is one time only special order. The hotel themselves, they contacted us and want to buy the blanket from us. All right. So in this instance, fixed manufacturing costs and fixed marketing costs will be irrelevant costs because by this special order, because it will not change regardless whether we accept the order or not accept the order. This blanket should accept the order from Amanda Hotel because it will increase the operating income by 17,000 and the fixed cost will not change and it contributes to higher operating income, right, and higher contribution margin for the company. Okay, now we look at this another section in this topic. It is whether we want to insource or outsource the product, or sometimes we call it as make or buy decisions. Alright, so outsourcing is basically purchasing goods and services from outside vendors or suppliers. Insourcing is where the firms, they produce the same product or service, right? So they make it by themselves. And this decision, sometimes we call it as make or buy decision. Alright, So managers, when they want to consider whether they want to make or buy the product, they always have to consider several factors, which includes quality, dependability of the suppliers to deliver according to schedule, make sure that the supplier will be able to deliver the product on time. And sometimes they also look at the qualitative factors. For example, some other things that cannot be measured by monetary terms, but in terms of customer satisfaction, things like that. Alright, so these are among the things that the management accountant have to consider whether they want to buy from outside or whether they want to make the product by themselves. Alright, so here is the example, right? And we're going to read all of these things together. Okay, the Zeno company manufactures a 2-in-1 video system consisting of a DVD player and a digital media receiver that download movies and videos from internet sites such as Netflix. So they give you an information in column 1 and column 2. It shows the expected total and per unit cost for manufacturing the DVD player. Now we just talk about DVD player. We ignore the digital media receiver because the question is actually related to the DVD player only. Okay, so the information given to you are the total and per unit cost for manufacturing the DVD player. The Zeno plans to manufacture 250,000 units in 2,000 batches. So they produce it in batches. Alright, they produce the DVD in batches, in 2,000 batches, where in each batch it has 100, it produce 125 units. So if we times batches with units, right, 2,000 batches with times with 125 units per batches, so we can get the total here 250,000. Variable batch level cost of 625 per batch. Alright, so it has a batch level cost because they produce it per batch. So for each batch, the variable cost is 625. So the calculation for this variable cost of 625, it is per batches, not based on the quantity. As we said before, the question gives you the information that they produce it in 2,000 batches. So certain calculation is based on the cost incurred based on the batch basis, not based on the quantity. Alright, so another company, that is Bobo Incorporation. Bobo Incorporation, a manufacturer of DVD player, offers to sell Zeno 250,000 DVD players next year for 64 per unit. Alright, based on the Zeno's preferred delivery schedule, means that Bobo Corporation is a good company where it can supply the product when up to the customer. So if the customer wants the product in specific dates, they will be able to deliver. They don't have a problem of delay in delivering the products. Assume that financial factors will be the basis of this make or buy decision. So we assume that once the management accountant want to decide whether they want to make or buy, it fully based on the decision based on the financial perspective. And should Zeno managers make or buy the DVD player? So this is the question. Alright, so here basically the information given to you. Okay, so we have two columns here. This is the expected total cost of producing 250,000 units in 2,000 batches next year, and this is the cost per unit. And the information includes, this is the information given, which includes direct material, $36 per unit times with 250,000. So this is the direct material cost. Variable direct manufacturing labor, so for labor is $10 per unit times with 250. So this is the cost for 250,000 units, and this is the cost per unit. So 9,000 divided with 250,000, we can get here, you know, like this information actually given to you. Other than that, variable manufacturing overhead cost is 1500, $6 times with 250,000, and they also have a mixed variable and fixed batch level manufacturing overhead cost, where once we produce it in batch, it occurs another cost that is they call it as mixed cost, where it includes both variable and fixed costs. This is the calculation, and it is for the material handling and setup. So 750,000 times plus with, this is cost per batch, 625 per batch times with 2,000 batches. So this is the variable cost based on the batches as they given to you the information here. Okay, all right. Okay, so this is actually the batch level cost, which means this cost only occur if we make or if we produce the product. Alright, so if we didn't produce the product, if we buy it from Bobo, so this cost will not occur. Okay, so we have to be aware of that. Alright, and last one is fixed manufacturing overhead cost of plant lease, insurance, administration, where the cost is 3 million. Okay, so this is actually the fixed cost in the sense that you have to be aware that it will not change whether we buy or whether we make. Whether we buy from Bobo or whether this company make by themselves, this cost will not change. This cost basically will change because it involves the cost involved per batches. So once the batches produce, so the cost will be occurred. So that's why this is become relevant cost for us. All right, if we look at this information nakedly, for example, we can just simply say that if we look at the total manufacturing cost here is 72 ringgit, $72. So it is basically higher than 64, all right, price that has been offered by Bobo. Okay, in the sense that we possibly think that, oh my god, this total manufacturing cost is too high. All right, the 72 is higher than 64. Why don't we just simply buy from Bobo? Nevertheless, in this type of question, again, it is very important for us to recognize which information is relevant, which information is not relevant. So this is important for the management accountant to make decision. All right, so here is basically the calculation how we should consider whether we should buy or we should make the DVD. All right, so if we, as you can see from this column, this is a make or buy decision. If we just simply buy from Bobo, 64 times 250,000 unit, this is the cost, 16,000. If we make, if the company, if Zeno company make the products, the direct material is 9,000. All right, okay, 9 million, 2 million and 500,000. This is direct manufacturing labor. So obviously once we produce the product, this cost will be we have to bear for this cost, we have to pay for this cost, and also the labor, and also the manufacturing overhead, okay, variable manufacturing overhead, as well as the cost for batch level. So all of these costs are basically relevant costs, because if we produce the products, if Zeno company produce the products, all of this cost is something that they have to pay. Otherwise, like fixed costs like this 3 million is irrelevant in the sense that it is a fixed cost and the company still have to pay regardless whether they make or they buy the DVD from Bobo. Okay, so as we can see in here, if we make the total relevant cost is 15 million, but if we buy, the total relevant cost is 16 million. It is higher, okay, higher if we buy rather than if we make. And as you can see here, if we make, the total relevant cost per unit is 61 while if we buy it, it is 64. So in this instance, Zeno should make rather than buy, because it is cheaper for Zeno to make rather than buy it from Bobo. Alright, now we look at another subtopic, that is products mix decisions with capacity constraints, in the sense that products mix means the company might have 2, 3, 4 types of products, but at the same time they also have a constraint in terms of resources that they have. So in this instance, they have to think which products that they should produce, which actually will give them better operating income. So we are going to look at these questions. Alright, I mean that because of the limited capacity or the resources that they have, the company have to think about which product they want to sell and at what quantities that might be fit with their resources or the capabilities that they have. Okay, we are going to look at this example. Power equipment assemble two machines, that is machine A and machine B, at its Pasigudang Johor factory. The following table shows the selling price, cost and contribution margin of these two machines, right? So machine A and machine B. We can see the selling price of machine A, 800. This one is 1000. Variable cost 560. This one is 625. And contribution margin per unit is 240, and this one is 375. And if you look at the percentage, the contribution margin percentage is 30% for machine A, but for machine B it is a bit higher, that is 37.5%. Only 600 machine hours are available. So this is the constraint that they have. They have two products with quite a good contribution margin. Nevertheless, the resources that they have is limited because they only have 600 machine hours are available daily for assembling machine. Additional capacity cannot be obtained in the short run. Okay? Power equipment can sell as many machines as it produces. Means that whatever product that they produce, there are a demand for that. So don't worry, it still can be sold. The constraining resource then is machine hours. It takes 2 machine hours to produce machine A. Okay, so in order for you to produce machine A, it took 2 hours. But for machine B, 5 machine hours. So what products mix should power recreation managers choose to maximize operating income? Alright, I make a correction here. This is not power recreation but power equipment. Okay, so if we look at this question and if we analyze the contribution margin per unit and the contribution margin percentage, we can see that machine B is obviously much more profitable than machine A. Nevertheless, in this situation, we cannot just simply look at this contribution margin factor only. We also have to consider the 600 machine hours, the limited resources that we have in order to choose the best products mix. And in this instance, managers should consider the product with not just with highest contribution margin, but also highest contribution margin per unit of the constraining resources, that is the machine hour, just the 600 machine hour that they have. Alright, so this is basically the determination that the management accountant have to make before they can make decision whether they want to produce product machine A or machine B. Alright, here is the solution whether we want to decide whether we want to produce machine A or machine B, or we want to produce both. So in this calculation, we can see that the contribution margin per unit as given to us, alright, is 240 for machine A and 375 for machine B. Okay, so look back at this at the question and you can see this information. We also have been given an information that for machine A, the number of machine hours is 2 hours, but for machine B, it takes, like 5 hours. Therefore, if we calculate the contribution margin per machine hour, in the sense that, alright, the contribution margin 240 per unit, okay, divide with 2 machine hours. So for machine A, for 1 hour, for 1 machine hour, we can get here 120 contribution margin for 1 machine hour. Nevertheless, for machine B, if we divide the contribution margin with the machine hour, 375 divide with 5 machine hours, we can get here $75 per machine hour. So for machine A, the contribution margin is for, if we invest 1 hour of our resources, we can get the contribution margin of 120. Nevertheless, for machine B, if we invest 1 hour in machine B, we only can get $75 per hour. Alright, so obviously if you look at this, machine A is much more profitable than machine B. Okay, and if, for example, if we calculate the total operating income or total contribution margin for this 600 machine hours, alright, because overall we have 600 machine hours, then simply 120 per machine hours time with 600 machine hours, we can get the total contribution margin of 72,000 for machine A, and for machine B, it seems that 75 per machine hour times with 600 machine hours, we can get here 45,000, and it seems that machine A is much higher compared to B, and in this instant we should produce machine A because it gives us higher contribution margin per machine hour. And if we calculate with the total resources that we have, we can maximize our operating income, we can maximize our contribution margin by producing machine A rather than machine B.